Are you an American moving to Canada and are going to have US real estate that you're going to be holding on to, potentially renting, waiting for the market to improve before you sell? Make sure that you watch this video. I'm going to go over the key cross-border Canadian and US tax matters you need to know as it relates to holding on to US real estate, renting it out, and eventually selling it as a Canadian tax resident. Hi, I'm Sonia. I'm a CPA licensed in both Canada and the US. I'm a cross-border tax consultant and co-author of my new book, Your Move to Canada, all about the financial, investment, estate, and tax planning matters as it relates to moving from the US to Canada. Make sure you check out the link in my bio so you can pick up a copy. I have an entire chapter on real estate. So let's talk about your US property. Lots of people panic and think, I need to sell my US property before moving to Canada because Canada has really high tax rates and I don't want to pay a ton of capital gains taxes to the CRA. But before you rush to sell your property, keep a few things in mind. First, Canada has something called a step-up in cost basis. So this means that the cost basis of your property for Canadian capital gains purposes is the fair market value of your property on the day that you establish tax residency. I posted a video yesterday about establishing Canadian tax residency and why it's really important that you know what this date is. I linked that video as well. So if your US home has a lot of appreciation and value that accrued during your US residency, so before you move to Canada, keep in mind Canada does not have a right to tax that gain. Only gains that accrued after converted to Canadian dollars during your Canadian residency period are ultimately subject to Canadian taxation. So if you end up actually selling your property shortly after you arrive in Canada, perhaps a few weeks or a couple of months, then you may not have to worry about capital gains taxation in Canada because ultimately your capital gain in Canada is going to be the difference between what you sold your property for, converted to Canadian dollars, and the value of the property when you became a Canadian tax resident, converted to Canadian dollars. So if the value didn't appreciate a lot, there may not end up being a capital gain in Canada. But if years go by, the value appreciates as you're a Canadian tax resident, then you do have some exposure to Canadian capital gains taxation. So that is why it's very important to document the fair market value of your property as of the date that you establish Canadian tax residency. Now, the CRA doesn't indicate that you need a professional appraisal, but you are ultimately going to have to defend that figure should they come back and ask questions. So a professional appraisal may make sense. Real estate confirmation, comparable market values. Ultimately, you just need to document how you came up with this value of what your cost basis is for Canadian tax purposes of your US property. Now, another thing to keep in mind if you sell your US property as a Canadian tax resident is thinking about what does the US say. So on the US side, there's the primary residence exclusion. What this primary residence exclusion says is that you can exempt up to $250,000 of capital gains per individual or $500,000 if filing jointly if you pass the ownership and use tests. So what these tests say is as long as you use the property as your primary residence for at least 2 out of the last 5 years up to the sale, then you could exclude up to $250,000 or $500,000 of gains from US federal taxation. But here's the issue. Once you move to Canada, you no longer use that home as your primary residence. The clock starts ticking, so you have to keep that in mind. Let's say that you move to Canada. You may have to sell the property within around 3-4 years in order to actually benefit from those tax-free gains in the US. But to the extent that the capital gain in the US exceeds any exclusions that are available, generally speaking, you're subject to long-term capital gains rates in the US, which are generally 15 or 20%. There may be an additional 3.8% NIT on top, depending on the value of the gain. Ultimately, if you have a capital gain in the US, you're subject to US capital gains tax. And there's also a capital gain for Canadian purposes. You can use that US tax as a foreign tax credit against the Canadian tax, so you're not double taxed at the end of the day. Now, let's get into renting out your property. As I mentioned in my video about Canadian tax residency that I linked below, Canadian residents are subject to tax on worldwide income, and that includes your US rental income. So you have to report your rental revenue minus expenses converted to Canadian dollars on your Canadian tax return. And similarly, it's also taxable for US purposes. So expenses are things like mortgage interest, property tax, insurance, property management fees, utilities that you pay out of pocket for. But let's say if there's a capital improvement, like a new roof, for example, then that generally is capitalized to the cost of the property, not necessarily taken as a write-off. So when you capitalize something, it effectively adds to your cost basis and would reduce future capital gains. So you're going to be reporting your profit on the rental income to the Canadian tax authorities and also to the US authorities. Since the property is physically located in the US has primary taxing rights. And what that means is the US tax that you pay, that could be federal, could be also state tax depending on where the property is located, that could be used as a foreign tax credit against the profit that is on the Canadian tax return. But ultimately, if Canadian tax rates are higher than US rates, which they often are, you may have to pay the difference to the CRA on the rental profit. But if your expenses exceed your revenue, you may not have a profit at the end of the day, so this may not be a concern. Now let's talk about depreciation. In Canada, we have something called capital cost allowance, or CCA. So capital cost allowance or depreciation for Canadian purposes is actually discretionary. You don't have to take it. And it's also only taken on the value of the building, not the land. And it's based on a percentage of the cost basis of the building. So that is another reason why as you move to Canada, you have to document what is the fair market value of that property, because that forms your cost basis. And taking it a step further, you have to document what is the fair market value of the building versus the land, because you could only take depreciation on the building portion. So for example, I'm in Vancouver. Here, real estate prices are very high, but about 90% of the value of the property could go to land, only 10% can go to the building. So you'll just have to make sure that you document that breakdown and make sure that it's well supported if the CRA comes back to answer questions. So I mentioned CCA, tax depreciation, it is discretionary. You don't have to take it. And you could only take it in order to reduce your rental income to zero. You cannot take depreciation to have a loss in Canada. So why would someone avoid taking depreciation? Because of something called recapture. Recapture may occur if you sell your property at a gain for Canadian tax purposes, but you took depreciation on the basis that your property is reducing in value. So any depreciation that you may have taken, or CCA that you may have taken, gets added to income in the year that you actually sell the property. Something to keep in mind is, let's say you took depreciation of $5,000 per year for 10 years, then that is a deduction of $5,000 per year, potentially at a lower tax bracket. But when you sell the property, if that $50,000 gets added to income all in 1 year, it may push you into higher tax brackets. So whether or not CCA or taking depreciation makes sense, it's a bit of a mathematical exercise, and make sure you talk to an accountant who may be able to help you walk through whether or not taking it is advantageous. And again, it's only relevant if you are in a profit position with your rental property. Now for US purposes, there's also depreciation. But the thing is with the US, even though depreciation is technically a choice, when you actually sell the property, they have this concept of recapture as well. And the US rules actually calculate your capital gain as if you took depreciation. So not taking depreciation actually doesn't benefit you in any way for US purposes. Also keep in mind, if you do have a rental property in the US, that is reportable on something called the T1135 in Canada, which is our foreign asset reporting. If you're familiar with the FBAR, we have something kind of equivalent called T1135, but it doesn't only apply to financial assets, also applies to rental properties. And you report the cost basis of your property for the T1135. So that is another reason why you need to document what is the value of the property at the time you establish tax residency. So if this topic is a little bit confusing and complicated, that is the reason why I wrote my book, Your Move to Canada. My co-author and I break down almost everything that you need to know when it comes to taxation, investments, retirement plans, real estate, trust and estate planning. We wrote it in a way that's understandable, strategic, actionable. You don't have to be a CPA to understand this. So if you're planning a move from the US to Canada, make sure that you subscribe to my channel and leave a comment. What are some cross-border tax videos you want to see? Have a good day. Bye.